Hey everybody, it's Neil Kearney from Kearney Realty Company in Boulder, Colorado, here to give you a year-end 2022 summary of the Boulder area real estate market. I saw the real estate market really change this year, and so what I'm going to do is talk about four things. I'm going to talk about the first half of the year, the second half of the year, a year in summary, and then where do we go forward from here. Predictions for 2023, year ahead. First half of the year was crazy. So we had really low inventory to start. Then we started the year with the Marshall Fire, such a sad event for our area. And it really just exasperated the low inventory and the high demand that was already apparent and kind of fueled a frenzied market that really wasn't exclusive to the Boulder area, but we were one of those areas that was really going nuts. So we saw bidding wars that were going hundreds of $1,000s over. Actually, during the first half of the year, an average sale in April, May was about 9% over the list price. And inventory continued to be really tough. We were seeing on the market low inventory, and then of the active listings, up to 76% of those listings were under contract at any given time. So the inventory was really churning quickly, and it was going away almost instantaneously. You had to be showing houses within that first weekend to even have a shot to compete. So the background during this time was that interest rates were rising, and back in November of 2021 we were just below, right around 3%, and then by mid-year 2022, just over 6 months later, we were over 6% and peaking out at 7% early fall of 2022. So buyers were not only competing with other buyers to get these listings that there weren't very many of, they were also competing with their numbers. So as time went by, their monthly payments were rising for the same price range, and so they were seeing their purchasing power really decrease as time went by. Really a stressful time for buyers. Once we hit late May and early June, we had a little bit of the air go out of the market. There were fewer buyers that were coming new to the market. And what we started to see was really by July, we were seeing more negotiations happen. So on not only up front on the price, but we were also seeing inspections. Buyers were able to ask for items to be done, and the sellers had to address those rather than just say, well, we've got two backups and take it or leave it. So we started to see a little more of a shift towards balance. And as the summer went on and into fall, now we're obviously talking about the second half of the year, inventory started to rise just a little bit. As I said, we had more negotiations. We had more cancellations, so buyers were seeing things slow down and thinking, I paid too much, and so they were canceling sales, transactions, not only on resales, but also on new home purchases, where they had locked in the prices earlier in the year, and their interest rates have gone up, way up, and the equation just didn't work anymore. So we were seeing cancellations and therefore lower sales. This continued through the fall, and no longer were we seeing the prices go above list price on average. Like I said, in April, it was about between 9 and 10% on average. In terms of the negotiation above list price for the average sale, later in the year, it was almost 4% and below. 4% below. So we had negotiation down below. And that shift took place about July, where we started to see the average sales price below the list price rather than above. So in summary, the year, the year, two halves of the year. How it all shook out was that sales by the end of the year were down 23%. We started the year strong, but then with the low inventory, we really didn't have enough new listings, even with the buyers that were out there, to match what we were doing a year before. In the end, we ended up down 23%. Later in the year, so I'm talking July, August, September, October, November, December, those months compared to the same month the year before, we were seeing typically down 20 to 30 and even close to 40% lower than they were the same month prior year. So just everything kind of just settled down, and fewer properties were going under contract, fewer properties were coming on the market, and fewer properties were selling. Prices. So for the year, prices were up 12%. Most of that obviously took place during the beginning part of the year. We were seeing houses go above the list price by 10% on average. That means that the outliers were 30% over. And then in the last part of the year, then we were going under. The outcome was from the prices for the year 2021 compared to the year in total 2022, we were up 12%. Early in the year, we were up 15%, and we came down a little bit. But prices are sticky. So let's talk about what we can expect going forward. What is 2023 going to look like? Well, so far, here we are, the latter part of January. We're seeing fewer listings come on the market. We're seeing inventory still really low. We're still seeing enough buyers out there to match that. So we have kind of an equivalent market. Buyers are kind of matching sellers, and so we have kind of an equilibrium per se, and so therefore prices are really kind of staying where they are. We're still seeing some negotiation, but we're not seeing the conditions in place that would lead to a negative appreciation or a depreciation of sales prices. So that's one thing. Prices are sticky. Sellers don't want to lower the price. And really, unless there is a glut of listings out there and a compelling reason why sellers need to lower their price to compete, because there's tons of listings and they're motivated to do so, distress situations, lack of equity, etc. If those situations don't come to pass, prices are going to kind of stick where they are and have normal negotiations. That's what I predict for the coming year, is prices are not going to rise very much. They're not going to fall very much. They're going to kind of be in that plus 2 to 3% range. That, of course, can change depending on if there's a bunch of new listings come on the market. But why are we not going to see new listings come on the market? Because sellers are stuck with, well, not stuck, they're fortunate to be sitting on mortgage rates that are really low. You have to have a really big incentive to pay off that mortgage at 2 or 3% and then jump into one at 6.5%. So if you're trying to downsize or buy a house in the same area, you're really disincentivized to pay off the old mortgage, get a new house at a higher price, at a higher interest rate. Your payment's going to go up. And so the sellers who are selling have a compelling reason why. Change in family situation, change in job that takes you out of the market, or death or divorce, things like that. So there are fewer of those than in a kind of a healthy market where sellers are looking for new houses in the same marketplace, in the same area, and moving up and moving down. Right now, those interest rates that are locked in at a low rate are keeping people in their houses. So we're going to see, because of that, we're going to see fewer new listings fewer sales and sticky prices, because that demand is going to be met with a low supply. So hopefully this is all helpful. If you like these videos, I would appreciate if you subscribe to my channel and hit the like button. That'll help me reach out to even more buyers who are interested in the Boulder real estate market. I'm always here for personal consultations. If you are considering a move into Boulder or need to move within Boulder or sell your house and move out, I'd love to talk to you and see what I can do to help you through a successful transaction and a successful move. I've been doing it for a long time and would love to help. So thanks again for watching, and I wish you a wonderful 2023. We'll see what happens. I'll keep you posted each month.